All right. Welcome to the March 25th meeting of the Rotary Club of Des Moines. Only 9 months until Christmas, so start your shopping now. I think I actually saw some Christmas decorations up in a store recently, a little early. We're glad to be at the Wakanda Club today with all of of you here in person and those out watching our live stream or watching later on our YouTube channel. Invictus continues to film our meeting, getting all those zeros and ones in the correct order. So members such as Art Feline and David Busick, who watch our live stream meetings, can be part of the Rotary experience. Welcome to all of you. Friendly reminder today to our virtual audience that Kitty is not here today, as she is out of town attending the funeral of her uncle, who passed away yesterday. So please don't try to text her or email her about any concerns with the meeting, the audio, or my performance, because she won't be able to respond to you today. And our sympathies go out to Kitty and her family for the loss of her loved one. We will be sanitizing the microphone between speakers, as we always do. We do ask that you keep your masks on when not eating or drinking, except when you're up here speaking from a microphone. And since Kitty is not here today to supervise me, maybe we should shake things up a little. Maybe have the speaker answer questions before he gives his presentation. Or maybe better yet, sing the Iowa State fight song after the pledge. I see mixed results to that. Anyway, again, no one signed up for the moment of inspiration. I'm not going to give you one today because you probably get really tired of listening to me all meeting long. So with that, let's go ahead and please stand, and we'll have the Pledge of Allegiance and then the four-way test. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. And now the four-way test. Is it the truth? Is it fair to all concerned? Will it build goodwill and better friendships? Will it be beneficial to all concerned? And now use your newfound talents that you acquired last week. Wave to your fellow Rotarians. And yes, wave at the cameras so people out there live streaming can see you. And again, for all of those cyclists out there, now through April 10th, you can help raise funds to end polio with the Ride to End Polio. I'm sure there's a committee set up to come up with the name of that event, which is put on by the Rotary District 6000. You can ride your bike indoors, counts as well as riding outdoors. You can walk, run, do anything to encourage pledges for your efforts. Get friends and family to pledge $1 for every minute or mile you ride, or walk, or run, or hold that recliner down on the floor. Collect those funds and then turn them in for the Rotary Foundation. Kitty can help you with that next week. And again, put it in perspective, each $30 pledge will provide 110 polio vaccinations. That can dramatically save the life of 110 people around the world. And again, thanks to Bill and Melinda Gates, their foundation, as they are doing a 2-to-1 match. So every dollar is actually worth $3. Just in case you're watching again, hi Bill, hi Melinda. And again, thanks for everyone being here in person. There's probably a few people out there that haven't been here for a while, so there might be some members that you haven't checked in with lately. Maybe think of someone you haven't seen in person or virtually And just go ahead and give them a call, kind of like we did a number of months ago for the Take 5 for 5. Just give a call or an email to a fellow Rotarian you haven't been in contact with recently to check in, see how they're doing, uh, discuss world events, the heartbreaking loss to Iowa State women's basketball last night. Ugh, I'm still upset about that. Anyway, but yeah, please give a call out to some of your fellow members. I'm sure they'd be glad to hear from you, those that haven't been able to attend our meetings. And before Tim Lilowitz come up to introduce our speaker, when it's time for questions for our speaker, please come up to the microphone, which we don't have a stand for this week. Oh, okay. All right. Instead, we're going to have Jordan go around. You raise your hand, and he will take the microphone over to you. And he has a large bucket of sanitizing wipes, which will wipe the microphone down between each question. And again, remember to please state your name clearly so those out in cyberspace can hear you. And then speak directly into the microphone, as I'm just being told, so that the live streaming people can hear you. And again, we will be sanitizing between speakers. So with that, Tim, please come on up. I'm sure it's not for me.
As Skeet would say, thank you for that rousing applause. I think we're in for a good presentation today. We have with us Dave Muth, who is the managing partner for Alternative Equity Advisors out in Clive. Dave is an entrepreneur building businesses that focus on agriculture data service technologies, creating economic opportunities from sustainability and soil health focused management, and creating innovative land acquisition strategies that deliver improved investment returns. Dave is trained as a mechanical engineer, receiving both his MS and his PhD from some university up in Ames. President Doug, do you know what that's called? He spent his first several years of his career building technology in advanced biofuels in partnership with the U.S. Department of Energy. In 2013, Dave co-founded AgSolver Inc. in Ames, an agricultural data service startup. Dave is currently focused on building Alternative Equity Advisors as a premier land investment firm, creating maximum financial returns for investment partners. His experience in agriculture technology, tough 2 words to say, coupled with actively managing farming interests, provide unique perspectives that deliver investment arbitrage opportunities for Alternative Equity Advisors clients. So now that I stumbled my way through that, let's hear from Dave.
Well, good afternoon. Thank you very much for the invite. It's kind of nice to talk to people in person as opposed to through a laptop webcam and Zoom. So it's kind of nice to get out. I'm going to talk a little bit about the farmland asset class with this particular focus on the sustainability pieces and what we're seeing happen in the marketplace. So to kick off, I'll give just a little bit of background to who we are. So Alternative Equity Advisors is a sister company to People's Company. I partnered up with Steve Brewer to help build out these investment firms. What we've got is a national scale, full service farmland transaction firm. Okay, and this is a little bit unique in the farmland transaction space, being able to cover all of these major agricultural regions. So land brokerage, management, appraisal, and then certainly the investment side is where I spend the majority of my time. A little bit of context on scale. The brokerage side has done over $1 billion in transactions over the past 5 years. Right now, our land management and investment platform have about $500 million in assets under management. And the appraisal business has done a little over 1.6 billion over the past 5 years also. A lot of deals, a lot of touch. So I want to give you just a quick look, right? So one of the really interesting things happening in the farmland space right now is there's a lot of capital that wants to engage. A lot of different sources of capital that want to be in farmland. And the chaos of the last year has certainly played a role in that. So we have a few different businesses set up in order to serve those different capital sources. Alternative Equity Advisors is sort of the traditional asset manager. We'll work with high net worth individuals, family offices, some institutional types to go out, build, and execute a farmland acquisition portfolio strategy. We've got a business called DST Farms. Has anybody heard of a Delaware statutory trust? Yeah, it's a really interesting framework for folks to be able to 1031 exchange, the tax advantaged exchange process on a fractional basis into new assets. It solves a lot of problems associated with 1031s. We built the first ever farmland DST here over the last year and a half. That's really interesting. So that's hitting folks that are probably a smaller bite, minimum of say $100,000, that want to get into farmland and have the 1031 exchange capability. We also have what we call Magma. This is fractional ownership. You might even think of it in the crowdfunding nature. Okay, so minimum $5,000 investment. So this is retail investors that want an avenue to get engaged in the farmland asset class. And there's a few other competitors to Magma that are emerging right now. It's really quite amazing the amount of uptake, the amount of interest in that retail investor space. We also do some structured debt solutions, and that'll make a little more sense as we move through here also. So let's talk a little bit about the asset class. If we look at the acres, over 70% of the farmland acres in the U.S. are still in our big three commodities: corn, soybeans, and wheat. Really important to remember. A lot of the value and a lot of the better returns are actually coming from more of these specialty kinds of crops that comprise a smaller amount. But if we're thinking about sustainability, we're thinking about the impact that farmland can play in some of these issues that we're seeing right now, we have to maintain a focus on those big three commodities. A little bit of an interesting dynamic. So this chart up here is showing commodity prices going back from 2013 through 2019. And you see that downward trajectory on soybeans, that downward trajectory on corn. Certainly, we've seen a little bit of a flip here over the past several months. But in that same time frame, farmland values have continued to go up. Now, they've slowed down a little bit, and this is an aggregate of all U.S. farmland. And so the story is, how does this really happen, right? Because we have to be generating less revenue from production, i.e., less revenue making it back to the asset. What's really happened is cap rate compression. The expectations of returns on the farmland have continued to squeeze over these years. Now, another important note on how this happens is that farmers are still buying 60 to 70% of the farmland, and a farm's always worth more to the farmer than it is outside capital that's looking at it from a pure investment standpoint. And so this has been an interesting dynamic that's really helped farmland in terms of its performance over the years. A little more context on the asset class. We're sitting at a little over $3 trillion asset class. It's big. One of the most interesting dynamics we see here, and we'll kind of go into this just a little bit, is the level of debt that's actually against that $3 trillion and how inefficiently capitalized this farmland asset class is. It's creating some interesting opportunities. How about performance? So this is lining up a few states and then an aggregate of the primary 32 states that have significant farmland against several other equities that a lot of folks are certainly invested in. Performance is really quite good, right? Over a long test period going back to 1990. And these performance, that 9 to 11% range, very consistent in farmland over any 10-year period going back to where data is available. And this isn't necessarily well understood. And one of the rubs on farmland is that annual cash yield component of the return is quite small compared to a lot of other assets, commercial real estate, multifamily, a lot of the other sort of real estate style assets. But the appreciation in farmland is very real. It's not just a pro forma, it's consistent when we look at it on a long hold basis. Okay, so this gives just a little bit of another look at this. If we came in with $1,000 in 1990 and we worked through farmland in several states against gold, S&P 500, couple other equities, it's quite astonishing performance, right? And NACREIF is a professionally managed farmland tracking mechanism, National Council of Real Estate Investment Fiduciaries. So this is institutionally, professionally managed farmland that pops up there on the top. This is really quite impressive, and this is one of the stability is one of the reasons why in fairly chaotic times we're seeing a lot more interest in farmland. So let's start to dig into where's it going? Where are we seeing some interesting opportunities emerge? What are the drivers that we're paying attention to? And there's four things here that pop out. Right now we're in a time where consumers are looking for a deeper connection with their food and how their food is produced than any time before. And most importantly, they're willing to pay more for it. Okay? That's a really powerful piece. It ties right into the sustainability story. And sustainability from a pure monetization standpoint has been pretty tricky in farmland, but we're starting to see where these opportunities are going to emerge. The technology piece continues to move very, very fast. I've certainly worked in this space, and we're seeing a little bit of this same sort of cycle where back in 2011 and 13, when commodity prices were quite high, the venture capital into ag tech was exploding. Then it kind of cooled off for a little while as things started to get tighter and tighter. Little commodity price run. A lot of deals have been closing lately again in that same VC arena, and I'll talk through that just a little bit. And then this whole notion of financialization, right? Inefficiently capitalized, very demographically dynamic asset class, and we'll talk about that just a little bit too. The first piece here on consumer preferences, right? I love that successful farming cover. I think they may be pulling something similar back up on this front. It is very, very clear that consumers are willing to pay for food that they understand the full story. This manifests itself in a few different ways. Certainly, we do a lot of work in the organic arena. Okay, and organic gives them that sense of connection for how that was produced in a way where the premium on those products is very well monetized. In terms of what comes off of a farm, it's usually 2 to 3x the price of a conventional non organic commodity or food product. And what's happening in the organic arena, as an example on this, is the demand is growing much, much faster than the actual production in the United States. Okay, so right now, about 80% of the organic soybeans that are consumed in the US are imported. They're coming from countries like Kazakhstan and Turkey and some African countries and some South American countries. And it's a well known secret, if you will, that a lot of that probably actually isn't organic. Okay. But it's very difficult to crack down on that in a big way, particularly where most of that's going to produce organic protein. And so now you'd create a major problem for the organic protein industry if there was a swift clamping down. So you put all of these things together, and you're looking at a runway where consumer demand going up faster than production, knowledge of import issues starting to squeeze. We actually see a nice runway for these price premiums on the organic front for a solid 10 years plus. Also, talking a little bit more about the technology. You know, there is a significantly simple value bridge that starts to come together. This is relative to our business and some of the things that we look at. Right now, we can go out, look at a blank piece of land on a map, and just with remote data and databases that are managed across USDA and several other resources, we can get a pretty darn good idea down to an acre level what the profitability on that farm is. Okay, the data resources are becoming very rich, and that allows us to do a great job of understanding how to make an investment perform, and then also thinking about how we want to manage it. Another really interesting piece on the technology side, we're able to, for our investors, engage a new level of management, meaning we can actually put together a farming operation, okay, and we can get live stream data directly from the tractors that are operating and the combines and the irrigation systems to where that profit from the actual farm operations adds a little bit of extra to the asset return, which is really quite powerful in the space that we're living in right now. So it's highly impactful and it's moving very, very quick. Let's look at this tech funding profile, right? This is another way to kind of think about this. Let's call this the quote unquote smart money. This is VC investments in the agri food tech arena. And it's continuing to go up. These charts are a little bit aged now. The dynamics have actually even increased on this front. I know as a farmer, farm kid, person who's worked in building the farm data services to that operational level, when I hear ag tech, I always think about this upstream list up here towards the top, right? Farm management software, better data for how and where I want to put my seed, monitoring crops, all of those sorts of things. The reality is that the big money in agri-food tech is going into the consumer connection, right? The e-grocers, the marketplaces, the traceability aspects, the downstream. That's where the really big investments are going right now from a digital and a technology standpoint. And that's an indicator that we need to watch for. There is a lot of money to be made by really being able to connect that consumer. Okay, so let's talk a little bit more about this financialization concept. So that $3+ trillion asset class, 13.9% leverage right now. It's an incredible number, right? The amount of capital that's just locked up in the asset that could, at a very low risk, be enabled to run free. Another component of this, 82% of landowners, U.S. farm landowners, are over 55, and half of those are over 75. Okay, over the next 20 years, there's going to be an incredible demographic turnover to the farmland asset class. Okay, and you put this all together, right now, the market, the realities of the market are driving some major innovation just in terms of understanding how to more efficiently capitalize. And this is going to move very, very fast as we go into the next few years. Okay, so let's start talking about sustainability just a little bit. I don't think folks will be able to make this graphic out, but what we've got here are all of the different logos for different brands that you buy in the grocery store, the gas station, etc. The reality is that all of those brands are owned by 10 companies globally. Okay? Within each of these companies, they even maybe have competitive brands at different price points, right? These CPGs, consumer packaged good companies, control almost everything we buy. Every single one of those companies has, and has for many years now. When I first started talking about this, it was interesting because some of the goals felt like it was out there a little while before they had to hit them. The corporate sustainability reports, CSR reports, these are all publicly traded. Okay, that means they have to answer to these goals to their shareholders. And the reason is because their shareholders were starting to say, what are you doing in order to improve sustainability throughout the ag supply chain? And there's some really incredible goals that have been put out there. General Mills, that's a little fuzzy, but they essentially said by 2020, they were going to have 100% sustainable sourcing of all of their products. What does that really mean? How do you define that? How do you actually sort that out? I'm sure in their report, they hit the goal, right? But we're talking about a somewhat nebulous, arbitrary definition of sustainability. We are seeing some things really start to emerge in a concrete and ways that we can monetize on a few of these fronts. So we'll talk a little bit about carbon. We'll talk a little bit about water quality and just the business management side and what we can do here relative to the sustainability story. One of the things that we are pretty excited about, this Leading Harvest logo that you see here, we actually were part of a working group with the largest, about 8 largest institutional landowners in the U.S., building a sustainability standard for landowners. Okay, this is really, really important. A lot of this conversation has been focused on, hey, we need to get farmers to grow more cover crops. We need to get farmers to do less tillage. It's focused on the farmer. The fundamental reality is that the economics work best when focused on the landowner, right? That's the long-term play, and that's the ability to really make the story and the case better. And so we're engaged in Leading Harvest. All of our managed assets are moving through that standard, and we actually have buyers of our products that are moving towards putting that label on their packaging. We think it's going to move pretty quickly, and we think that it actually has a really nice shot to be impactful in the marketplace. So let's talk about carbon just a little bit. We just entered a partnership where we're going to get 20,000 acres into a carbon trading platform that'll actually bring money back to the land in 2021. Okay, so carbon as part of the climate change discussion, right? Right there is significant initiatives all the way through USDA, all government branches with the new administration, certainly within USDA. And farmland, agriculture and farmland has been identified as one of the ways to have an impact quickly on reducing carbon footprint. Now, it's always been challenging because of two words: additionality and permanence, right? So, additionality is, well, wait a minute, how do I actually quantify in a meaningful way on an annual basis additional carbon that's now locked up in the soil or in some sort of growth cycle versus what would have been there before? And permanence being, hey, I can build soil carbon with 10 or 15 years of no-till, and then I roll my moldboard plow out, and boom, it's gone, right? So these are major issues that are out there. But we partnered with this group called SIBO, who's using a modeling framework approach, which is not perfect, right? But this has got to be a process where we don't let the perfect get in the way of the good. Do we want more cover crops? Do we want less tillage? Can we create some monetized transactions around that? And this is a little bit of an example from some analysis we've done with some partners on some funded projects over the years, but just context. And you don't have to necessarily look at the numbers, but the color here falls, and I have major color issues. I'm colorblind, so don't trust me on this. Somewhere in here on the middle of this scale in terms of GHG emissions from operations on an annual basis. And this is standard corn soybean rotation with conventional tillage, conventional management, how it's effectively done now. And then we come down here, and this analysis is done at a very, very fine scale, down to a soil type level and built back up. And we just say, hey, we're going to go to no tillage and we're going to put a cover crop in. Huge, huge change in your GHG emissions across this scenario. This is pretty well understood. The practices are understood, right? The problem with the carbon marketplace is that the quantification is tricky because it's long term, right? You can't really see all of the signals over until you get into 5, 8, 10-year kinds of spectrums. But we are seeing money move, and we're going to make it move on 20,000 acres here this year. Let's talk a little bit more about water quality. So everybody remembers the Des Moines Waterworks lawsuit. I can't even remember how many years ago, but suing the 3 counties up in northwest Iowa associated with the nitrate loading. This is the watershed, right? These are that were essentially named in that lawsuit. All of the individual parcels. This goes back to the story of, hey, we can grab one of these farms. We can tell you what crops have been on it. We can tell you within 5% what the yield's been. We know what the cost of production has been. We know what the standard practices are. We can actually characterize what's happening pretty well without having any information directly from that farm. Now, when we put this together, this is, you can kind of see the colors. I'm not sure how much they're jumping out here, but across on this scale for, again, this kind of conventional management strategy. And we have a massive step forward when we go to this no-till and this rye cover crop. And what's happening right now is there's some partnerships that are starting to develop, public utilities with private partnerships, where the utilities are starting to understand, hey, I can actually make investments in practices upstream more cost effectively than building new infrastructure to clean up the water. And so now we start to create a mechanism by which the almighty dollar can drive some actions as we move forward. We start stacking these things, and these externalities all of a sudden move from a real challenge to get adoption to an actual money maker where the dollars and the business cases are driving what we want to do. Here's another example where we get in and we think about managing farms at a different scale. Okay, this is a simple example where these are profitability maps. This is actually a farm that I farm, and you can see this is a sandy ridge that actually cuts through here. It never makes money. In fact, it loses $500+ per acre. Okay, so what we did is we sat back and said, well, why are we beating our head against the wall with that? And we went and put it into pollinator habitat where we get a $280 per acre per year payment for having pollinator habitat grow from NRCS. And it flips it around, and we move from making an average of 17 to $20 an acre on the farm to over $100 per acre on the farm. And at the same time, our soil erosion goes to from effectively 10 dump trucks worth of soil. It's a graphic that can help people understand on an annual basis down to 3.5. Our soil carbon build increases significantly. And just from this one farm making a change that actually makes me more money, and now I've got the technology to be able to implement it more easily, I'm changing the CO2 emissions, the equivalent of 3.5 cars coming off the road for a year, right? So this kind of ability to understand what's going on, make the decisions, and subsequently implement practices is also really at our fingertips now. And a lot of these programs and a lot of these externalities are going to continue to drive and make this move faster and faster as we go forward. So with that, I would take any questions.
My name is Mark Snell. I have a couple of questions for you. A couple of slides came up and made me think, why isn't Wisconsin colored on the one map? Number one. That's a kind of a simple question. But on the other side here, just looking at the whole idea of using the NRCS, isn't that taxpayer money? And if it is, how is that actually helping our economic side of it as well? Granted, you're making money, but you're making money off of the taxpayer potentially. So if you could just kind of discuss that a little bit and where the real funds are coming from. So you're making a business case, yes, but you're making it also at the expense of the taxpayer to make that happen.
Yeah. So good point. So the Wisconsin question, is just the nature of that analysis. I had to pull that out of the bank. The analysis wasn't done for Wisconsin in those particular cases as sort of visual demonstrations of the information at hand. Yes, NRCS and the conservation programs are part of the taxpayer-funded USDA portfolio of programs. So the reality is that the conservation programs and the associated Farm Bill elements they're going to be there, right? And if we can leverage the program dollars that are available now for a broader set of outcomes that actually still drive better business cases. So let's think about it this way: the impact from a let me see if I can go back. The impact from an environmental and a business case on this particular farm, taking 15 acres out of production that really should have never been in production anyway, is substantial relative to somebody saying, hey, I want to go throw 200 acres of mid-tier performing ground into the program, so then I never have to worry about it and I just cash the check every year. So I would argue that this context of management ultimately lowers the need for those taxpayer dollar incentives while having a bigger impact in the long term. Now, if you're coming from a perspective that says, hey, this just doesn't make sense to have the taxpayer dollars moving in this direction, period, then there's conversations around what are the highest best use sort of functions. And one of the things we looked at with this farm is forage production, right? Do I just produce some forage? Well, I'm in north central Iowa here. I don't have a lot of forage needs anymore. That didn't necessarily work. Another one we've looked at is, hey, cellulosic biofuels, right? Or cellulosic energy sources. Can I produce some crops that have high levels of carbon below ground that ultimately can create a little bit of revenue? And you start falling down that spectrum. In this case, absolutely, from the unit perspective of this farm, the best business outcome is that particular conservation program.
Hey, thanks for coming. Kevin Kassir. My company, just processes or makes equipment for processing soybeans, so organically, done it mechanically, so it fits right in the organic stream.
You bet.
So I want to talk to you about organic a little bit more.
Yeah.
First of all, you know the USDA has some new controls being put in place, so maybe you could comment about that, about putting more controls out there for so-called organic coming over. But then the other problem with organic here in the U.S. is that, I'm sure as you know, is that it's difficult to get enough farmers to convert over, right? Setting aside for 3 years, in order. Do you know of anything or doing anything creatively to help that, to offset that need for more organic products in the U.S.?
Yeah, so interesting dynamic there. To your first question, yeah, so it was last year, and I'm trying to remember exactly. I want to say it was in the summer that USDA released some of their tighter controls that are popping out. I'm certainly not an expert on the specifics of those controls, but my understanding is that they were developed specifically around helping clamp down on the a fraudulent import issue. That what they're specifically doing, I don't have those details, but there's some pretty good popular press out there for folks if you want to kind of dig into some of those things that have emerged. Related to the farmer question, it's an interesting dynamic, isn't it? Where a lot of the big ag commodity groups actually kind of fight some of the non-GMO movement, some of the organic movement. They push back, and there's good reason for that in some context, right? No-till is not really viable in an organic rotation because how else are you going to kill weeds? At least as we sit right now. Okay, it, and there's the thing that confuses us a little bit from time to time is these things can make more money, right? We can make more money as farmers, and we should be inviting the highest revenue sources that we can create. And it feels like we push back on it a fair bit. So, in answer to your question, there's some demographic trends among farmers too, right? It tracks the landowner demographics that I talked about, pretty similarly, and then you start to see a little bit of uptake and a little bit of uh, more willingness to adopt new production systems like an organic or the several variants of that within some of the younger folks that are coming in and starting to work right now. What we're doing specifically is we're putting initiatives together with these capital sources we work with that 2 years during transition of no income doesn't functionally impact their business, right? These are investment strategies that over a 10-year term are going to make significantly more money. And I think that you're going to see a significant uptick as you see that land transition really take off from a ownership demographic standpoint in the coming years. And the other thing that we're doing is, and I mentioned this very briefly, we're operating them directly. So the landowner is actually buying the equipment, putting the workforce in place, putting a manager in place, and building that expertise rather than having to look to the local farmers who may not want to go that route. We're actually just building it in conjunction with the capital source. So we are moving down that path, and we're working on right now, kind of putting together an investment thesis around an organic rice transition. There's a lot of interest in organic rice. If you just look at the trend of organic rice adoption, it's not that compelling. But when you have conversations with the Anheuser-Busch's of the world, the Chipotle's, the Costco's, like, hey, we really want it. We just don't know how to get there, right? And so now we can come mobilize a $500 million worth of capital that wants to buy organic or buy rice ground and convert it organic and have a better 300 basis point better return over on a 10-year basis. And you do it in partnership with that downstream draw, right, from the consumer in order to get it done.
You for being here today. Is there a way that you can market this program to the hobby farmer? I mean, are they open to such a thing? How do you communicate that to them? Is it worth, is it too small of an operation to get any benefit from some of these programs?
No, the hobby farmer level oftentimes can be a little bit more nimble in some ways, right? Because trying something maybe isn't as much of a potential financial risk, right? Whether that's moving to a reduced tillage type of scenario or putting a cover crop in. So when we're talking about carbon, an acre under a management change is an acre under a management change, regardless of whether it's packaged with 10,000 other acres or 100 other acres. So those sorts of revenue sources are very much there. It gets a little bit trickier on the hobby farmer level when you're talking about engaging new markets that might require capitalization of equipment, as an example. So if I'm moving from farming conventional commodities to organic commodities, as an example, that's a pretty big turnover in equipment. And if I don't have the acres to attribute those costs to, that can start to get problematic. But in terms of externalities and the ability to try different sustainable management outcomes, these funding sources are going to be available to anybody who's managing an acre within the required parameters.
Name is Dave Dixon. As the technology becomes more sophisticated and the options more variable, does that make corn suitability ratings less important, or is it still just on top of corn suitability ratings?
That's a great question. Corn suitability ratings and CSR, for folks that may not have as much background, every soil in Iowa is given a corn suitability rating. We're on to version number 2. And functionally, land trades is priced according to that corn suitability rating. It's on a 0 to 100 scale. You tend to be able to track it and move it through. So the short answer is that's a metric that's going to be there, and it's going to be an important, and it's really good given the sort of broad set of variance that you see across the landscape. But what we do start to see happening, and it's happening now with some of the remote sensing, is the ability to go in and see, wow, this farm's had cover crops on it for 10 years. Okay. That's actually going to create a carbon dynamic, a water infiltration rate dynamic, several other nitrogen cycling metrics that actually allow it to produce more revenue, regardless of the CSR2 rating. So you'll start to see the market pay more attention to management, catalog management, and validate it in a lot of ways. And that will start to create a layer of variance on top of just a standard CSR. The pace by which that happens, it's kind of hard to say. I think we're already seeing a little bit of the front edge of that.
I'm Don Flannery. Thank you very much for being here today. Question. You're seeing companies like Costco getting more involved in the supply chain, particularly like with their chickens and so forth that they serve. So are you seeing more of that on the grain side? Some of the processors that need more grain, are they trying to vertically integrate like that as well?
Yeah, it manifests itself in a lot of different ways, right? So if you're in the primary commodities, um, there's some major efforts for gathering information from a traceability standpoint, where they can try and document practices associated with what they sourced. The commodities, the big commodities, are working the way the big commodities work, generally speaking. You're just seeing some of those efforts to get a little bit further and a little bit more information in order to meet these demands for the consumer, which aren't perfectly defined. Now, there's some scenarios out there that are getting really, really engaged. One example, General Mills, they have their Annie's brand, sort of organic pastas, right? They actually partnered with a large institutional investor to buy 30,000 acres in west of Pierre, South Dakota, to produce the organic wheat specifically to serve that Annie's brand, right? And concepts like that we're starting to see more and more of that make its way into the market. It's certainly there in the fresh market, fruits and vegetables. You absolutely see it there. It's a clean line, but we're seeing some of those reaches associated with things that are a little bit more specialty, even in the food and feed grains.
Try to rip my glasses off. I'm Skeet Wooten. Thanks for coming today. You mentioned earlier that 80% of the farmland was owned by people who were 55 years old and older. So implicit in that comment is there's going to be a tremendous generational transfer of wealth. Most of those heirs, I would presume, are not in the agricultural business. Some certainly are, but selling the land, paying the taxes, things like that, you're talking about scaling up. So do you see more and more of that continuing, going on as this generation passes?
Yeah, the short answer is yes, right? In these scenarios, in a lot of ways, they're a little bit heartbreaking, because you've got the you can generalize it, right? Four heirs, parents pass away, land rolls down. Four heirs, three of them are off in their professions, that haven't been to the farm or have minimal connection with the farm. Maybe one heir is still trying to manage the farm. They simply can't capitalize the land. How do you create scenarios where that starts to work? We've got some of these business units we're constructing to be able to bring capital to the table that can help that heir stay on the land and then potentially even reacquire it in the future. And I think there's going to be some strategic structures that are emerging in terms of opportunistic capital being able to show up with somebody that's very committed to that farmland resource. That'll be a component of it. But yes, in short, we do see the large scale capital having a bigger presence in not just farmland ownership, but also farmland operations. Thank you very much.
Thank you, David, for being with us here today and your very informative presentation. Might give you some criticism. Maybe if you could be a little more knowledgeable about your subject matter. Wow. That's impressive. Thank you very much. And just because you're so knowledgeable, we are donating the book today, Animals That Make Me Say, Ew, to the Downtown School Library in your honor. And I know you've scribbled some words of encouragement in there to our young readers, and I have no idea why Kitty picked out that particular title for you, but appreciate you writing some words in there for young readers, as I said. All right. So thank you, everyone, for being here with us again today. Also, thanks to Jordan and to past president Jamie Boersma. Yay, let's give her a hand. Helping out while Kitty is out today. So Jamie came in early, helped get everything set up, and we'll get things torn down and back to the office. So thank you again, Jamie. Upcoming speakers. We don't have our PowerPoint today. I apologize. April 1st, Tim Kirchmer with Sports World, and he is also bringing former NFL professional football player from the Indianapolis Colts and Tampa Bay Buccaneers, Steve Grant. Imagine you'll be able to pick him out next week. He's probably going to be a short, little skinny guy. And on April 8th, we're going to have Jeff I'm going to butcher this every time, Delvio from Adventureland. And on April 15th, one of the meetings we always look forward to every year are Educator of the Year awards. Boy, if an educator was worthy of an award at any time, I think this year would probably be the time that everyone should get one. And again, thanks for being with us here again today in person, or watching our live stream, or watching later on our YouTube channel. And as always, my theme for this year, as you go forward this week, please think of others and try to leave something behind. With that, we are adjourned.